And welcome back to the channel. Today we'll be sharing about a new feature that we have recently just launched at StockPenguins.com. So we have just launched the Analyst ratings feature, which will showcase the Analyst ratings for any single stock out there as long as it's covered by an analyst. So if you head on to the Analyst ratings page, right, I've already preloaded Apple as a selected stock because it's something that I think everybody understands, right? Everybody knows the company. So over here, we will show the current trading price of Apple and the consensus price target set by analysts, right? So this is like the averaged out price target by all analysts out there that's covering Apple. And then we also show you the potential upside or downside from the current trading price versus the consensus price target, right? We also show you like the lowest price target set by analysts and the highest price target as well, where current price is trading at, right? And also what is the consensus price target. Okay, we also show you, right, all of the individual ratings breakdown by analysts out there. So we have strong buy, hold, and sell, right? So we'll show you like for instance the percentage of analysts out covering Apple has recommended a buy rating, right, over in the pie chart here, right? We also show you the recent updates by analysts on their ratings for Apple, right? So for example, you can see the analyst and the firm that they belong to, the date where the update is issued, right? What is their previous price target, right? Previous rating, right? What is the new rating? What is the new price target? What kind of action that they did, right? So for example, this guy from Jefferies, right, he on the 3rd of October issued a new underperform stock rating on Apple compared to the previous whole rating, and he has set a new price target of $205, right, which implies a negative 17.2% downside from where Apple is trading at now, and this actually constitutes a downgrade, right? So understanding all this data is one thing, but how do you make use of it as a retail investor? So which is what I want to share further now, right? So what are analyst ratings? So analyst ratings are essentially a sell-side or independent equity research report on single stock names. And what does it contain? So on a widely available level to retail investors, right, it will show you their verdict on a single stock, which usually constitutes a buy call, a hold call, or a sell call. Or another term will be the overweight, equal, or underweight the stock, right? So this is basically their overall thoughts on whether you should buy, hold, or sell the stock that they're covering. A price target of the stock and a time horizon. So usually this is commonly 12 months out from where the rating is first issued, right? So they usually have a price target set out 12 months from where it is trading at, right? And if you are a client or have direct access to the information or detailed report provided by this sell-side firms or independent equity research firms, you will get their models and forecasts on EPS, revenue, margins, and key assumptions of the company, right, and how they achieve their price target set out, right? And further details such as qualitative commentary, which will share more on their thoughts of the competitive positioning of the company, the risks that the company may face, and any catalysts that may drive the company's performance ahead further and on their stock price as well, right? So what are the pros of understanding and getting access to analyst ratings and reports, right? So this is the pros basically just includes that an analyst, right, can surface industry knowledge, management color, because they might have direct access to management as well. They've been speaking to them through their investors relations on behalf of all these buy-side firms who may be buying their reports from them, right? Model forecasts with data that you may not have the time or resources to build, right? So they're doing all the heavy research work for you with data that you as a retail investor may not gain access to, right? Like for example, a lot of research firms nowadays will take into account big data, even satellite data, looking at traffic going into say a Walmart, for example. These kind of things that you as a retail investor probably will not have access to, but an analyst with all these kind of resources may model their ratings based on all this information that they have gathered, right? And also, analyst ratings, right, provides consensus estimates and price targets that may aggregate many viewpoints and sometimes, right, embed information that may not have been priced in. So some analysts may uncover something that's a bit unique from the current market standpoint, right? And all these consensus price estimates, right, will aggregate all of this information and put a price target out there, which may not be fully absorbed by market participants yet, which is why there's a price deviation of where current prices are trading at and the consensus price targets, right? Limitations. So you may want to take analyst ratings and their reports with a pinch of salt because there may be a conflict of interest present, right? So as mentioned, most of these analyst ratings and reports come from sell-side firm and equity research firms, right? They may want to sell you an idea and product, and they may generate fees from their services on selling any commission, things like that from this, right? So they want you to act on the information. So that's something that you have to be wary of. Number 2, it may show optimism bias and ratings inflation, right? So historically and statistically, most analyst reports are positive on average, right? So there's a skew towards the buy and strong buy ratings because like I mentioned, it's because of the conflict of interest. They want you to act on this kind of their ratings and information for you to use their services, right? And there may also be herding mentality present by analysts across all institutions out there. So for example, if a very highly reputable firm like Goldman Sachs issued a buy rating on Apple, another firm from maybe a smaller bank would want to follow the rating as well. They wouldn't dare to challenge like the big boys, right, and the ideas that they have, right? It could backfire on them. So they may choose to go the safe route and issue the same ratings, right? So there may be some form of herding mentality present. And number 3, rating changes may usually occur after events or earning updates, right? So and this may not be dynamic and live in nature, right? There's usually a delay. So all these rating changes may be reactive, which may or may not be beneficial to you as a retail investor because you're always acting on like delayed information. Like for example, lots of analysts were calling for the overall stock market to decline further after the April 2025 tariff issue, right, where the stock market plunged heavily. And you see many single stock names suffer heavy drawdowns, and then that's where you see all the ratings start to come in, where they turn to be bearish and things like that. But look at where we are now. 6 months later, markets are trading beyond all-time highs, right? So always take all these changes and ratings with a pinch of salt. So as a retail investor, how would you use analyst ratings? So number 1, right, is to use them as idea generators, right? Do not simply buy or sell just because analysts say so, right? So do not use them as buy and sell signals. So it could be a good source of leads and data points and questions for you to test out as an investor. So always do your own research and make own judgment call. So for example, an analyst may issue a buy rating on a company like Hims and Hers, which is facing some form of headwinds now because of the regulatory issues regarding all their services and products, right? So from there on, you may start to think, why is the analyst bullish on Hims and Hers? And that's where you deep dive further down into the company's financials, the fundamentals, the narrative trading around it, what the management is saying, are they confident? And with all this information that you've gathered, right, then you make an judgment call on whether you should buy or sell Hims and Hers, or don't do anything at all, right? So don't just follow blindly what the analyst says. And number 2, always find out who provided the ratings, right? So as mentioned earlier, there's always a conflict of interest of relationship and background, which could impact the bias and risk tolerance of the core ratings issued, right? Which historically is usually positive in nature. Number 3, check consensus and trajectory changes of the ratings, right? So compare the current rating and target to the consensus and to recent upgrades and downgrades. So rating changes often matter more than static rating, right? So find out why there is an upgrade or downgrade, which could also lead to a broad-based sentiment change for the stock price. So like I mentioned earlier, right, most ratings are positive in nature, but if you see a stock that has been historically whole or underperformed start to gain attention from buy ratings, right, this could lead to a change in sentiment of the stock itself, which could drive stock price further ahead as more attention and liquidity flows in, right? There's more optimism, correct? And number 4, like as mentioned earlier, just wanted to reinforce the point. Compare the analyst assumptions to your own simple sanity checks. So this is especially so if you have access to the analyst reports where you can see their model and how they they model their financials, right? So you could use StockPenguins company's financials too to deep dive into the financials, performance, historic key ratios of the company itself, right? And not just compare against the analyst ratings. Number 5, look at the implied upside and versus your required returns, right? So most analysts set price targets that are 12 months out, and based on that, you can roughly tell how much potential upside the company may have versus where it's currently trading. And then you could take this percentage return as like a hurdle for you to compare against your personal return hurdle target. So say for Apple, right, it has implied upside of about 3% as shown earlier. Is that the return that you want over 12 months? So probably as a growth investor, you wouldn't consider Apple anymore. So that's a very easy way to filter out your potential investment pool, right? Number 6, weigh ratings according to source quality and independence. So for example, if we go back to the case of Apple, right, analyst ratings, right? So Apple's a very good, high quality company, so you may not have all of the information that you want. But if you see over this case, right, there's like companies that you may know, like Jefferies, Morgan Stanley, they're all very reputable firms. But there's random companies like Maxim Group, right, Raymond James, individual analysts. You may take all these less reputable firms, their ratings with a more, with a grain of salt compared to like the big bang, which has more information, right? But that may not always be the case, right? So you need to understand each analyst, their background, right, their agenda, and how experienced they are with the company and also in the industry, right? For them to for you to trust the ratings, right? And I'll take for them into account, right? Number 7, check the number of analysts covering a stock. So over here, you can see Apple has 109 analysts covering it. But if you compare to another company like say Zeta, right, it has only 15 analysts covering it. So why I say this, right? So the more analysts and the more reputable firms covering a single stock, it could prove to be like a safer or less shady company in a sense, right? So you feel more assured parking your company with like a company that has a lot of analysts covering it, because with that much analysts covering it probably I say probably, right, but it probably ensures that most of the dirt of the company has been flipped around. The company isn't shady, it's not trying to hide anything, because it can't really hide anything from like so many analysts trying to find out what it does, how it's performing every single day, right? And number 2, an increase of analyst coverage could often time serve as a catalyst for stock price, right? So as more analysts cover the stock, there'll be more attention and then potential liquidity flow because of discovery, right? So more investors may find will know of the company and its prospect and feel like, oh, this might be something to invest into, and then you see all this inflow coming in and the stock can potentially benefit from that. So explore the ratings feature yourself, compare it to your own research, right? And then that's all for today. Thank you.